And not to leave silver out of the equation, as we've said before, the best consensus is $80 silver. And that is in the shorter term, not in further out, which really anticipate somewhere in the region of $140 to $200. So what we look at here is for stackers to be able to shake off the smoke and mirrors legacy market shackles and to join forces with every single central bank and sovereign investor now racing to exchange their rapidly debasing fiat currencies, treasuries, for real world zero counterparty risk bullion. There simply isn't enough above ground bullion to meet this demand at current prices. That's true for both gold and silver. So let's start with the first clue.
Andrew Maguire argues gold and silver are manipulated lower by leveraged paper markets, COMEX, while central banks and BRICS buyers accumulate physical metal. This creates a supply shortage at fake prices. He identifies predictable manipulation patterns at pit opens and month-end that create buying opportunities before explosive rallies. ETFs like GLD/SLV lack real backing. He predicts silver will reach $80 short-term and $140 to $200 long-term as the paper-physical disconnect collapses. Thanks for watching. Subscribe to Fine Metals for more updates.
Sets the detoxified rally point. All residual naked short gold, gold and silver ETFs, the GLD, SLV, I'm primarily talking about those two ETFs. All of these shorts have to be bought back at market, driving an even higher point to rally from. Thus, the latest in the series of wash and rinse cycles completes. Now, we talked about these ETFs in the past. We've done whole episodes about ETFs. If you can short, and you can, and there's something like 4 billion in SLV shorts, big amount of GLD shorts. What it means is if you're a shareholder in those ETFs, it's not there. The bullion's not there. To some degree, it's not there. Many people think it's not there at all. But I'm just saying it's not one-to-one. And if everyone suddenly, if there was a black swan event and you turned around as an institutional and you said, I want to cash in, you're going to get unallocated, cash settled positions. They are not going to be, everything you invested, what you thought you invested for, would be eradicated. It would be marked to fiat market, as if, in other words, you'd have lost all the wealth protection that you wanted. So that's why so many people avoid them. However, unfortunately, if you are a fund and you're not mandated to hold physical, you're forced to. You're forced to take, because it's a share. So you're mandated to buy and sell shares, but not hold physical. Therefore, you will be buying GLD, SLV. Are these guys by central banks, sovereign, and very large institutional buyers who have exited these COMEX exchanges, understanding, as the central banks do and the sovereigns do, that this is a 54-year-old legacy marketplace that is so deeply underwater from a paper to physical perspective, they become vulnerable. They're literally being targeted for this bullion. So what we're seeing is when we see periods of backwardation, this activity to arbitrage these differences actively steps up. I mean, significantly. So futures to spot foreign exchange backwardations can only exist following the creation and selling of synthetic leveraged gold supply, which determines the non-deliverable cash settle price, which is so blatantly at odds with the global physical supply demand prices. However, those that look purely are siloed within that COMEX exchange. A lot of US traders look And the speculators, momentum traders, chasing a dot up and down a screen, they don't see anything beyond that is the price to them. And it really is why they're wrong at both ends when suddenly they see, hey, hang on, what used to work doesn't work. So quite simply, the larger the size that I or anyone else or client wishes to buy, exponentially increases the price above the published prices, even the FX fixes, which are limited to 3 to 5 tons out of the 600 to 800 tons of unallocated gold that sloshes about. So if I want big size, then you just literally index that and add the premium. So what people try and do is literally just take a nibble at it without taking too big an order, because what it does is exponentially push that price up. However, when you've got a price being set, and it's usually just 4 business days before the end of the month, and they get marked to market, so they're contained into what is a multi-billion-dollar options expiry event, which severely compresses the undeliverable paper gold price bets against real market deliverable demand, followed by a race by these bad actors to short cover these bets the instant that these synthetic prices are squared. Now, these prices affect billions of dollars of interrelated derivative bets. So basically, they're doubled down on, but causing a huge dislocation between the real price and the derivative price. Now, but as we've said many, many times in the past, see, here's the pit open. So these house capping events are most noticeable after the Asian market finishes trading, and then the house capping events commence at the pit open. Now, and this is where they appear, and we've seen it multiple times. This was yesterday's efforts. We're recording this on Wednesday. This was yesterday's efforts, but they reveal a weak hand and are capitalized on by BRICS buyers lining up at the back door to load out underpriced bullion, which they know is underpriced because the mark-to-market event forced it to be so. And this is exactly what results in a series of higher physically supported stair steps. It's exactly the same in silver. So this off-COMEX market, unleveraged physical buying, it flies under the Western market radar until one of two things occur. One, sufficient 96% leveraged, siloed gold futures, long and short open interest. In other words, the speculators left who will go and buy these chips off the house, the open interest basically, which is depleting. So basically, once we got enough, once this short open interest runs out of sufficient supply for the commercials who come in at the pit opens and derivative mark-to-market event. So if there is insufficient supply for these commercials to offset accruing unleveraged T+1 delivery obligations, that's a problem. Next, there's one. So the next thing would be that the next higher leg of the freshly established, physically underpinned supply-demand support price, they are then, because the momentums will go long after they've been short, they're going to begin to tailgate the next leg of the physically driven rally. But here's the point, from a higher support level. It is these so-called balance points that we're actually tracking and sharing with you. Anything that turns up at the fix must be T+1 deliverable, 1 day deliverable physically. So these T+1 spot market fixes, they ultimately determine a global market deliverable price, and it's underpriced. However, physical market liquidity has broken free of the West's toxic gold price concoction, that's all I can think it is, into the BRICS-centric SGE and international facing SGEI physically settled trading hubs where a competing real supply demand price is fixed twice a day. Now, this price is a real price. This price feeds into the rapidly expanding Western-facing gold corridor, pushing back where Western paper to global physical differences are systematically arbitraged, the unprecedented backwardations. This is an action call and a massive opportunity to front-run the next leg higher. Futures market backwardations to spot, what they do is telegraph the legacy December gold and silver futures prices, which we've just been tracking, have been physically mispriced. Now, hang on, this is the largest largest price-setting futures exchange globally. Paper futures, cash settled. So basically, these December contracts, which everyone looks to for a reference, have been physically mispriced. And while the spot market is influenced by these diluted prices influencing the local London fixes, where deliverable bullion can be sourced, because it's diluted with synthetically generated, unbacked 96% leverage COMEX supply, the exponentially larger global-facing T+1 deliverable, i.e., must be delivered under Basel III compliance rules, charter that you look at aside, and again, deliberate chart chatter. In other words, excuses to pull the bids, really, as we've shown in the videos, in the chart sections, how pit managers come in, how options expiries, derivative expiries, mark-to-market events, how their footprints come in at the pit open, how these guys are desperately protecting a position, but are getting arbitraged. So what's happening is short-term chart chatter, as we say, aside, it's these prices that ultimately translate into a higher physical supported stairstep. And this brings us to exactly where we are in the latest derivative gold related West to SGE wash and rinse cycled. Now, we've now reached the inflection point of the current toxic wash and rinse cycle, where net of these arbitrage flows, there are no matching real offers to sell bullion for immediate delivery into current supply shortages. Backwardations reveal just the tip of this iceberg price mismatch. Now, very short term, albeit synthetically diluted global facing, that's the unleveraged Basel III NSFR compliant local London fixed prices, as they're locked in, spot indexed in other words, for T+1 delivery, it alchemizes these differences that we're talking about. And it's impossible to hide. And illustrated here, at the end of the month, derivative bets get marked to market. Outside of the legacy market, it's almost irrelevant. So whereas the global-facing liquidity providers servicing very strong unleveraged physical central bank sovereign institutional demand, while they stealthily arbitrage these mispriced, exchanged for physical basis spreads, i.e. the difference between this underpriced COMEX bullion, it's not bullion, it's underpriced synthetic gold versus the real cost to buy that, even though it may be diluted slightly in the West still before it enters the gold corridor. That basis spread, EFP basis spread, is definitely stealthily being arbitraged without raising too much drama. So short-term are sticky. They don't want to sell. They're not, they used to be, you'd short sell these ETFs in the hope that you could rinse out people and buy them back cheaper. They're sticky. They're not leaving. However, the moment the wrong at both ends momentum shorts, controlling 85% of all the COMEX open interest, the chips, the moment they're rinsed out, officials then begin to take the short side of these same directional momentums, who then go long. And this is the wash and rinse cycle, which is beginning to, because of the lack of this open interest, because you haven't got institutionals actually coming in and playing that game, it's a lot shallower. And so then the House basically